Welcome back to EDS, and in this video I'm going to share with you the secrets of how to trade a small account in a way that allows you to grow your account very fast and very consistently. And there's two things that we're going to use to be able to do that. The first thing is options contracts. We are going to write the options contracts, we're going to be selling the options contracts, or we're going to be short the options contracts. All of those terms are interchangeable, and specifically we are going to be writing those contracts on top of futures contracts. Now the reason why we do that is because options contracts, or specifically writing options contracts, allows us to control our trade. It allows us to get very high probabilities of success, and the reason why we write them on futures contracts is because futures uses span margin, which is very capital efficient. It's a different way of calculating margin compared to equities. And you also have no PDT rule, or pattern day trading rule, although we won't run into any PDT issues anyway, because the contracts that we write are typically 30 to 45 to 60 days out in time. So step by step, here's what you do. First thing is open up your brokerage platform, and you want to see a watch list of futures contracts that have options available to trade. Now this is a pre-made watch list. Any good broker should give you this watch list, but if not, you can just take note of these ticker symbols here. So what you want to do is order everything from high to low IV rank. Now the reason for this is because as option volatility rises, or as volatility rises, option prices rise. Okay, and we are going to be short the contracts, which means we're going to be selling high, buying low. So if we are selling in a high IV environment, that means that we have a high probability of volatility contracting, which will lead to lower option prices, which will be positive for our P&L. And the reason for this is because volatility is mean reverting. Okay, so we order everything from high to low IV rank, and we typically want to sell contracts on futures contracts that have a high IV rank. So we just go down the list, and generally speaking, currencies are everything is capital efficient, but currencies don't require much buying power. So we're going to focus on currencies, but you can experiment with any of these tickers here. All of them are capital efficient. Span margin is span margin. Okay, so we've got our first currency here, which is the Canadian dollar futures. Now it has an IV rank of 63.6. It's very liquid. Pretty much all futures are extremely liquid, so there's no issues there, and it has an IV level of 9%. Now you might be thinking 9% is quite low. Now span margin takes into account the IV. Now because currencies don't really move that much, relatively speaking, your buying power requirement is significantly less than with something like natural gas, for example. So that's why we like currencies, especially for small accounts. However, even for larger accounts, currencies are great. So we've got our first ticker here. We could go one further down, the British pound futures with an IV rank of 52.5. Anything over 30 is good. So anything from crude oil upwards is good. Generally speaking, over 50 is very good. You want to have a kind of nice mix of things with a mid to high IV rank. You don't want things that are just very, very high IV rank. Anything, have a nice spread of things between 30 and 60. But let's just go with the Canadian dollar futures here. So what we want to do is go over to where we can see a list of expiration dates for that underlying, which is the Canadian dollar futures. Now, as we can see here, we've got a list of expiration dates, and you need to keep in mind that there's two expiration dates here. You've got the expiration date of the options contract, and then the futures contract itself also has an expiration date. Now, any good broker will automatically integrate both of these things together. So as you can see here, the February 7th and March 7th option expiration dates correlate to the 6CH5 futures contracts, and then if you go over to the April 4th, May 9th option expiration dates, those correlate to the 6CM5 contracts, and so on and so forth. So you don't really need to worry about the futures contracts expiration dates too much, as long as you are focusing on the options contracts expiration dates. So how do we know which one to pick? Well, we're going to go over to here where we can see how long is left on these contracts. We want to pick an expiration date that's roughly around 30 to 60 days away. So as we can see here, we've got 49 days, which is the March 7th contract, which is perfect. So we're going to open up the March 7th contract, and now we are presented with the options chain. So what we do here is we craft our position. So let me just explain what's going on. So on the left we've got calls, on the right we've got puts, down the middle we have our strikes. This orange horizontal bar shows us where the price of the Canadian dollar is with respect to the strikes, and this vertical orange bar shows us what the expected move is of the Canadian dollar futures over the next 49 days. So we want a high probability of success. Now when we are writing options contracts, we don't want price to go anywhere near our contracts. We want price to stay away from our contracts, and we don't want price to breach our contracts. So what we want to do is sell contracts that land outside of the expected move. Right? That's just common sense. So how far out do we go? Because the further out we go, the higher our probability of success, but the less premium that we collect. And premium is what we get paid, and that's how we make money. So we want to find a nice balance in between going far enough out the money to where we have a high probability of success, but also collecting a healthy amount of premium to compensate the risk that we are taking. And we've also got these dotted blue lines here, which are our standard deviation levels, and we're going to use the expected move, standard deviation, and delta. Delta is on either side. We have our positive deltas on the call side, and we have our negative deltas on the put side. So generally speaking, we want to be delta neutral. So we want to balance out our calls and puts. So what we're going to do is we're going to pick a strike with a delta of between 15 and 20 is where I like to be. So on the call side, we have a 14 delta and a 21 delta. Okay, so let's just be a little bit conservative and go with the 14 delta. Okay, and that's going to land us at the 0.715 strike. So we sell this contract here, and then on the call side, we do exactly the same thing. On the call side, we have a 15 delta, which is close enough to the 14 delta, and that lands us at the 0.67 strike. And if you notice, these contracts are outside the expected move, and they are up against the one standard deviation level, which is roughly where we want to be. And as long as you pick a 15 to 20 delta, you'll typically land in and around this area every single time. So with that being said, what's happening here? Well, we've created a range for ourselves, and we want price to stay within this range. And if price does stay within this range, then we keep 100% of the premium that we collect up front. And if that's specifically if price is within this range at the point of expiration, which will be in 49 days time. Okay, now what's the likelihood of that happening? Well, if we look in the bottom left corner, we have a pop figure here, a pop of 74%, and pop is probability of profit. So that means we have a 74% chance of making at least 1 penny on this trade at expiration. Now, if we don't want to hold till expiration and say we want to get out at 50% of max profit, we have a P50 here. Now, P50 isn't displayed for futures, but generally speaking, your P50 is going to be about 10 to 15% higher than your pop. So we'll be looking at probabilities of success for taking profit at 50% of around 85 to 90%. So we've got probabilities of success overall between 74 and 90%, depending on how long you want to hold this position for, which already is very high. We already have very high probabilities of success. Now, how much money can we actually make on this position? Well, if we look in the bottom middle here, we have our mid price, and this is the price that we're going to try and get filled at, which is 0.00310. Now, for equities, you have a contract multiplier of 100, which means that one contract controls 100 shares of the underlying. So you would multiply this number out by 100. But this is futures, and for futures, your contract multiplier is different. It varies depending on which futures underlying you're trading. But basically, futures are much bigger products, and for currencies, it's in the hundreds of thousands. Okay, now, I believe this is exactly, it has a contract multiplier of exactly 100,000, just off the top of my head. If we were to work this out, 1, 2, 3, 4, 5, yeah, I believe it's 100,000. So if we look here at the max profit, it's already calculated for us. So you don't really need to worry about what exactly the contract multiplier is, just as long as you know that these products are much bigger than equities. So we've got a max profit of $310. So if we were to get filled at this mid price here of 0.00310, we would collect $310 in premium upfront, and that would get added to our cash balance straight away as soon as this order gets filled. Okay. Now, our broker is going to require just over $457 in buying power to open this position. So we need $457 tied up, and we're going to collect $310 upfront. Now, as you can see, this is already a very high return on capital, and it only requires $457, which is suitable for small accounts. Now, what you can do is you can be a little bit more aggressive, and you can go to, say, the 20 delta. Okay, so we go to the 21 delta on the call side, and we go to the 19 delta on the put side, simply because that's the strike that's closest on either side to a 20 delta. Okay, and if you look in the bottom middle to the left here, we've got a delta of negative 0.02, which is, for all intents and purposes, that's basically delta neutral. Okay, it's very unlikely that you'll get it exactly 0.00, but 0.02 is absolutely fine. That's basically delta neutral. So how does that affect the numbers? Well, we have a slightly lower probability of profit at 68%, still very high, but of course that's going to be slightly lower because our deltas have increased. But the premium that we collect has also increased because our risk has increased, so our reward has increased. Now, our max profit is $470, and our buying power requirement is $546. So our return here is now even higher. Okay. And this is basically how you can structure your position in a small account. And what you want to do is you want to have as many of these positions on as possible, within reason. We're going to go into that in a little bit more detail later on. But you want to have as many occurrences as possible in your portfolio, to allow the numbers to play out, to allow averages to work out, so that you're not affected by any short-term variance, basically. Okay, and this is basically what you do, and you just do this over and over and over again. We've also got this theta number down here in the middle at the bottom, which is currently 11.801. So what that means is we're going to get a daily theta decay of $11.80. Now, that means that assuming all else stays equal every single day, we will make $11.80 on this position every single day. And theta decays more aggressively as we get closer to expiration. Okay, so there's still 49 days left on this contract. Every day that goes by, assuming all else stays equal, this number will increase. So not only are you getting paid every day, well, you technically get paid everything up front, but in terms of P&L on paper, you'll be getting paid $11.80 every day. That will increase with time as we go through time. So we are quite literally converting time into profit. Okay, we've got a high return on capital, high probabilities of success. And that's essentially it. That's how you find and manipulate positions. Okay, now how do you know how much buying power you should be allocating to your positions? Depending on what size account you have, how much of your account should you be using, etc., etc. Well, in order to figure that out, we have a free position sizing template that we've created that's available for everyone to get a copy of. The link is in the description. Just click the button and it will take you over to a spreadsheet that looks like this. And the way it works is you enter in the size of your portfolio. So say if your portfolio is $5,000, you then enter in whatever the current VIX level is. So say if it's 21.3, and then everything will be automatically calculated for you. Now, this will tell you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this, you'll be absolutely fine. Now, you do need to keep in mind that this position sizing template is geared towards properly sized accounts. So if you do have a smaller account, you may need to bump these numbers up a little bit and be slightly more aggressive, just due to having a small account. That's just the way it is. But as long as you are generally sticking to this, you'll be absolutely fine over the long run. Now, if you want to learn in more detail about what we do and how we do it, again, link will be in the description, but this time click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments all in real time. There's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. And if you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee. So once you've studied the full course and followed some of our trades, after 6 months, if you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's £1 a month to join. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life, so you are definitely rewarded for getting in early. And the aim of EDS Premium is to teach you the skill of writing options contracts, regardless of what size account you have. It's something that you can take with you for the rest of your life, and we want to get you to a point where you don't need any external help or influence. You don't need us, you don't need anybody else. You know what to do. It's a skill that you've learned, and we aim to get you to that point within 6 to 12 months. You are always welcome to stay and be a part of the community. However, within 6 to 12 months you should be good to go. So with that being said, I will see you guys on the inside.